Good afternoon, everyone. Thanks for joining us today. My name is Michael Morgenstern, and I'm the head of marketing for the Expert Institute. Today's webinar is on the topic of business valuation in commercial litigation, presented by Ronald Quintero. Mr. Quintero is a highly qualified financial expert with over 30 years of professional experience at leading firms. He is currently the principal of a financial consultancy and the founder of Chartered Capital Advisors. He was an investment banker at Bear Stearns, an insolvency and restructuring advisor at Zolfo Cooper, and also started and ran the first valuation practice of KPMG. The webinar will run for approximately 60 minutes and will be followed by a 10-minute Q&A. You can type your questions into the question window on your control panel, and Mr. Quintero will answer your questions verbally. Thanks again for attending, and please welcome Ronald Quintero.
Today's program, as Mike just said, my name is Ron Quintero, and I'm happy to have the opportunity to spend the next 45 minutes talking with you about the tip of the iceberg of issues that come up in connection with business valuation. And as I say, this is the tip of the iceberg. As an example, I give all-week seminars for people who do nothing but this for a living, and it winds up being an intense 40 hours. So what we're going to do is highlight some of the issues that are of greater relevance. Although hopefully you pick up a bit of knowledge along the way. And Mike has told you about the Expert Institute and the various things that it does, as well as giving you a bit of my background in connection with business valuations. The things that we're going to talk about are going to be examples of some issues in which valuation becomes significant in litigation. We'll talk about valuation concepts and premises, basic valuation approaches. We'll look at the 3 examples of valuation analyses and talk to you about both sources of valuation services as well as valuations licenses and standards that may be applicable. Lots of reasons that valuation can become a significant issue in connection with litigation. Just to mention a few that I'm either currently or was recently involved in, I've got one case, a financial services firm, where the managing partner was voted out for cause by his partners. So the issue is, what is the value of his partnership interest? Now, there's a reason to believe that it may be a moot point because there is a buy-sell agreement, but as you know, in the law, there are often reasons that people may take contrary views. And so I've been engaged to do a valuation on behalf of the partners. The former managing partner has an independent valuation expert from a large accounting firm that has done the work on his behalf. Now, granted, we are both highly experienced, highly credentialed valuators, but to give you a sense as to why this is not black and white, his expert says the firm's worth about $50 million. I say it's worth about $7.5 million. And so there'll be 3 arbiters who will listen to our rationale. Another example, pharmaceutical company. A couple years ago, it was sold to a large European company for $3 billion. About a year prior to that, the vice chairman had sold some of his interests subsequent to retiring based on a valuation of $800 million that was prepared in connection with an annual ESOP by an independent valuation firm. Given that the firm, a little bit more than a year later, was sold for $3 billion, he filed a lawsuit saying that the majority shareholders shortchanged him. They knew the company was going to be sold for a higher price. And so again, he had an expert that came up with a value of, that case, a little bit under $2 billion. I came up with a view that the price that was paid at the time that his interest was redeemed was fair value. And that was something we were actually able to, or not we, the lawyers were able to get that action dismissed. Another example, The former CEO of a rather prominent firm owned 10% of the stock in that firm. When he died, his estate sought to get fair value for his stock. They thought that his estate was being shortchanged, so there was a lawsuit. His estate hired an investment banker who came up with a view that the stock was worth about $110 million. The company came up with a view based on an independent valuation expert from an accounting firm that the company was worth about $8 million. So obviously there was a rather large discrepancy. I was the mutually agreed upon neutral, and my recollection is my value was about $12 million. Current case, secured lender in bankruptcy has as its collateral virtually all the tangible and intangible assets of the company. So the key issue is going to be what are those worth? To what extent is the secured lender over or under secured? A lot of unusual types of assets come up in connection with valuations. Another case, a finder was entitled to a stock option in a company, and so there was an issue: what was his option worth? Options fall within a category of a somewhat esoteric area of valuation. Here was another case where I, representing the former CEO of the company, had a significantly different value than the finder's expert came up with, and in that case ours was able to prevail. In fact, it was one of those beautiful cases where not only did we prevail, but we actually got damages, an award of fees as a consequence of the lawsuit filed by the finders. Lawyer malpractice, something that perhaps touches a raw nerve or is near and dear to many of you. In this particular case, a law firm provided legal services to a tequila company that was an early stage company that did ultimately fail. And as often happens in the world, people look to see who can they potentially blame. And they decided, since the firm failed, there was no money to go there, so they decided to go after their lawyer. They decided somehow it was bad legal advice that gave rise to their loss. And so the issue that I dealt with on behalf of the lawyer was to demonstrate that the company was basically worthless, and so whether he did or didn't commit malpractice, it had no bearing on the outcome. On the other hand, the plaintiff's expert said the company was worth $50 million. So there again can be huge differences. Dissenters' rights in going private transactions got involved in a number of those. One that comes to mind: a company went private, formerly publicly held company. The company's shares were purchased from public shareholders at a price that represented a premium over the publicly traded value. The dissenters asserted there was much greater premium. And again, both our firm on behalf of the company and dissenters through their expert presented views with respect to valuation that became the basis for settlement. Another case, pharmaceutical company. They had worked with a client of mine, a smaller pharmaceutical company, that got involved in developing some drugs, which the rights to which were ultimately supposed to be assigned to my client. They never fulfilled their obligation to assign the rights to those drugs, and so as a consequence, my client, after a few years of litigation, sued for the value that he was deprived of by virtue of this pharmaceutical company failing to fulfill their contractual obligation. Here's another case where the difference between the bid and ask was huge. The pharmaceutical company, which had not yet introduced a drug, asserted that it was worthless. I came up with a view that it was worth several $1 million, and we were ultimately able to get a settlement that was well into 7 figures. But again, these depend upon the credibility of the analyses that are done. Another thing near and dear to many of you who may have earned professional degrees or other licenses during the course of a marriage in many states, including the state of New York, that is potentially a marital asset. How do you decide what that is worth? How do you assign a price to enhanced earnings capacity as a result of earning an educational degree or professional license? Well, those values can be huge. Another application, have a case where it's a personal injury case. A up and rising artist who had won significant recognition in his early career had his career brought to an end as a result of being in an automobile accident. What is the value of the economic impairment that he sustained based on the trajectory that was already evident from his career? Another example, in terms of this is America, anybody can sue anybody, it seems. I have a case that, unless there's a continuance, is going to trial next week. A client of ours entered into a contract to sell a business to a buyer who was not able to complete the sale by the expiration of the purchase agreement. Therefore, my client put the company back out into the market, found another buyer that paid a higher price than the original buyer who was unable to fulfill his obligation under the purchase contract. Then a couple years later, that prospective buyer decided that he lost an opportunity, that he had a bargain purchase price, and that bargain purchase price was not just the price that the subsequent buyer paid, but in fact it came up with an economic analysis suggesting that that value was much greater. So it's going to be up to a jury to decide whether or not, by virtue of lost opportunity, this prospective buyer was in any way harmed, assuming that he did have a right to be able to buy the company after his purchase agreement had expired. What is something worth? There's an apocryphal story about the recruiter from the CPA firm who goes on a college campus to recruit potential employees, and the stock question is, what's 1 + 1? Well, the people who say 2 are the ones that get blown off. They don't get a second interview. The ones that say, what do you want it to be, are the ones that get the next interview. Well, I don't want to say that valuators are that manipulative, but very often what something is worth is dependent upon what standard do you use for determining value. For example, fair market value. Classical definition of fair market value, you see it cited to this day in many valuators' reports, comes from Revenue Ruling 5960. The price at which the property would change hands between a willing buyer and a willing seller when the former is not under any obligation or compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of relevant facts. Now, fair market value is a transaction-based concept. So it assumes that the property has changed hands between willing buyer and willing seller. So it's not a forced sale. It assumes that everybody had all relevant information as a basis to be able to effectuate a transaction. And in many instances, people make the assumption that if a transaction closed, that was fair market value, and it may or may not. Another definition that has withstood and been the result of quite a bit of controversy over the years is fair value. Now, the one that underwent the greatest amount of debate is the one that came out in about 2005 through something known as FASB 157 under generally accepted accounting principles. That's a basis for fair value accounting. A committee comprised of members of the Financial Accounting Standards Board and others worked for a few years, debated, and ultimately decide that fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, some of the significant issues about fair value, as defined by the Financial Accounting Standards Board, is it reflects exit value, the price at which you could sell the asset, as opposed to entry value, the price at which you could buy the asset. and they're not necessarily the same. For example, let's say back in 2009, when the real estate markets were depressed as a result of the Great Recession, it's possible that in a distressed sale, a buyer might be able to buy a property for less than it's worth. Well, the purchase price is the entry value. For purposes of a tax basis, that would be the basis assigned for purposes of determining future gains and losses. But that entry value, that purchase price, may not be the same as exit value, the price at which the asset could be sold in an orderly transaction if it was deemed that the transaction was not orderly. It wasn't effectuated in a time frame that would be normal for that type of asset. Another application of fair value that often comes up is there may be assets for which there is no market. So the concept of fair market value may not be applicable. For example, some of you on this webinar may be sole practitioners, where you have a law practice that is entirely based on your personal capabilities, your contacts, your sweat of brow. There may not be any market for your practice, but it may have a fair value that is applicable to you based on your ability to be able to earn a living from the practice of law via your practice. There are many types of assets that would not be sold, such as copyrights, trademarks, that still may have a fair value to the holders of those assets. Within a litigation context, fair value can vary a lot from state to state, from application to application. When we're doing this work, as we do it throughout the country, one of the things we'll always ask the lawyers is the extent to which there are statutes and cases that can have a bearing on how fair value can be interpreted within their jurisdiction, or that may impact how it is even based on the purpose of the valuation. Other things that can come up in litigation determining fair value is certain professional and other standards that may have a bearing. And then anytime you go to court, you're also potentially susceptible to the J factor, that being the personal beliefs that a judge may have who's ultimately going to render a decision if it's a bench trial as opposed to a jury trial. Some of the issues that come up in connection with fair value include what is the valuation date? Very often it's pretty well established. For example, in divorce cases in many states, it's the value in which the divorce litigation commenced. But sometimes there are other issues that may have a bearing on valuation date. For example, subsequent events. I had a case a few years ago where a private equity firm, actually it's a hedge fund firm, had two shareholders that owned 30% of the stock of the firm seek to get bought out pursuant to their buy-sell agreement. And their buy-sell agreement said that a mutually agreeable expert had to be retained to be able to determine fair value. And so that mutually agreeable expert wound up being one of the big four accounting firms. And after they didn't like the number that the big four accounting firm came up with, they came up with a basis for suing. And one of the issues that came up in that case was subsequent events. In that particular fund, this was a hedge fund that had a wide range of things that they invested in. And one of them was they bought the rights to the death benefits of life insurance policies. Well, in this particular case, there was a policy they held on an individual who had a terminal case of cancer who died subsequent to the valuation date. and the death benefit was not unsubstantial. It was a $70 million death benefit, which was material in relationship to this fund, which had a little bit less than $1 billion in assets under management. And so on the one hand, there was knowledge as of the valuation date that this individual did have a terminal case of cancer, but at the same time, his spouse filed a lawsuit and was planning to file a lawsuit claiming that the hedge fund didn't have the right to the death benefit. And in fact, on the $70 million policy subsequent to the death, because there was litigation, one firm offered to buy the death benefit, but the offer was less than $30 million because they knew there was substantial risk that it could not be collected and possibly none could be collected. So what was the appropriate valuation date? Was it the date as of the withdrawal of the 30% shareholders, or do you consider this subsequent event and give full credit to the 70 million or partial credit or no credit at all? Another issue that comes up a lot in fair value is, let's say that we have a situation where a 20% shareholder in a company is being bought out, and so is his or her value 20% of the value of the company, inclusive of the adverse impact on value of a minority interest position? So, for example, let's say the company is worth $10 million. Is he or she entitled to 20% of $10 million, that is $2 million, or is it $2 million adjusted for a minority discount? And it's another area where you can see cases all over the place on that issue. Discount for lack of marketability. What if on that $10 million valuation, that is made under the assumption that the company could be sold for $10 million? Therefore, if this individual has a 20% position in the company, he's entitled or she's entitled to 20% of 10 million or 2 million. However, a sale presumes that a liquidity event has occurred. That does not happen when there is a redemption of an interest. So the remaining shareholders do not have liquid assets. The $10 million would only be realized in the event of a sale where liquidity had occurred. Again, this is something that you can see cases all over the place. Another issue that can come up is, how do you treat a buy-sell agreement? Is that binding? I had a case a few years ago, state of Connecticut, where a client of mine owned 90% of the stock of a privately held company. He hired a highly capable woman to be CEO and gave her 10% of the stock, believed this was going to be a long-term relationship. He had known her for many years, and so he created a buy-sell agreement that had a very inflated value for her 10% interest, under the belief that, number one, the value of the company would increase over time, and number two, that it was hypothetical because she wasn't going to leave. Well, about 2 years later, she did leave. She sued for the value reflected in her buy-sell agreement, and that 10% of that value in the buy-sell agreement actually represented more than half of the value of the company through a combination of the valuation was inflated in the first place, plus also the company had experienced some degree of deterioration. So that can be another obstacle. Finally, another thing that comes up is, are we talking about cash value versus value realized in installments? For example, those of you who have a small law firm, if you were to sell it as opposed to merge it, typically the terms of sale would involve some down payment and some payment over time based on some combination of earn-out as well as other deferred payment. If you were determining fair value in connection with a divorce, how would you treat the fact that it may take several years for you to realize the full value, and in fact there could be some uncertainty with respect to full realization of that value? And going back to page 8, there are several other valuation concepts that could be used as a frame of reference for determining value. So again, there's not just one single indication of value. Which valuation premise are we going to use? Are we assuming the company continues to operate as a going concern, which is most often the assumption, unless we're dealing with bankruptcy situations, in which case, with the firm and or certain assets, do we assume orderly liquidation, so the value that could be realized, for example, let's say we're talking about a retailer and they've got inventory, if you could sell that inventory off over a period of a couple or a few months, normally orderly liquidation on a gross basis is going to yield more than forced liquidation if you have to sell it all in a single transaction on a single day. Another distinction is the value in use. For example, you've got a law firm. Depending on the size of your firm, you could have thousands or hundreds of thousands of dollars or millions of dollars worth of computer equipment, furniture, books, other things that on a value in use basis, let's say that the net book value, net depreciation of those assets was $1 million. Well, assuming you continue to practice law, value in use may be $1 million. However, the value in the event that you were to sell those assets, sell used computers, used furniture, is likely going to be a fraction of that. Another issue is value to the holder. Sometimes an asset is of greater value to a particular holder than it is to other people. That's sometimes referred to as investment value. For example, if an individual has a 48% interest in the company, buying an additional 3%, which converts him from being in a minority position to a controlling position, could cause that 3% interest to be worth much more to that individual than it would be to others who would not realize the benefit of control. Any valuation is going to be only as good as the analysis of the business or assets that underlies the valuation. So simply calculating or applying valuation formulae, in many cases, that's the easy part. The part that requires a lot more knowledge and judgment is getting a clear understanding about the business, about its futures prospects, its risks, and other factors that ultimately go into whatever numbers that are used to be able to come up with value. You know, value is very susceptible to what's referred to as GIGO, garbage in, garbage out. If you don't do a good quality due diligence, then the resultant value is likely to be compromised. There are three families of valuation approaches: the asset approach, the income approach, and the market approach. So sounds pretty similar. Why has it taken me 35 years to develop my knowledge in this field? And why do I continue to learn more all the time? Because there are a wide variety of ways by which these three general approaches can be applied, and there are also hybrid methodologies that incorporate two or more of these approaches. For example, an asset approach: what's the company worth based on its underlying assets? Well, there are several ways that we can determine what those assets are worth. We can look at what are they on the books and records of the company, but that doesn't represent necessarily what they're worth if you were to sell them in a transaction. That's just based on depreciated historical cost in accordance with generally accepted accounting principles. Sometimes there's a focus on the tangible net worth of the company, so back out intangible assets such as goodwill. Appraised value, and appraisers can use more than one assumption as to how they come up with their appraisal of tangible or intangible assets. What it would cost to replace assets. For example, in a fire where you can't buy a used asset in many cases, you can only buy it brand new. And then finally, we talked about alternative ways of determining liquidation value. Income approach. What's the business worth based on its income generating capabilities? Well, there are several forms of income that we may wish to capitalize or discount, ranging from dividends to free cash flow to equity holders. That is, what is the cash flows that you could put in your pocket if you own the stock of the company. Free cash flows to the firm, where we're looking at the cash flows the business throws off without regard to the debt and equity structure of the company. And then there's discounted cash flow analysis, where we project the applicable cash flows and terminal value, the value of the business at the end of the projection period, and discount it to present value to come up with a value today for the company. And then there's a variation of discounted cash flow analysis called adjusted present value. Then there's the market approach, where instead of looking at asset approaches or discounted cash flow or analysis or income approaches, which are sometimes characterized as forms of intrinsic value, what are the values that can be realized from looking within the company, with market approaches, they look outside the company for some benchmarks that may be relevant. For example, the capitalization multiples of publicly traded companies. Valuing a privately held company, say we develop price to earnings ratios from the public equity markets, apply them to a privately held company, and then adjust them as appropriate for the risks and other unique attributes of the company. Or we may also look at merger and acquisition transactions deemed to be relevant to the privately held company that we're valuing, or in connection with a going private transaction, using them as a framework for evaluating the reasonableness of a proposed purchase price. Another issue in terms of capitalization multiples that comes up is, do we use equity capitalization multiples as opposed to enterprise capitalization multiples? What's the difference between the two? Enterprise value is the value of the company without regard to its capital structure. Another way it's described as is the debt-free value of the company. For example, to compare enterprise value to net equity value is enterprise value minus debt. And we say debt from a corporate finance perspective, we mean borrowed funds, so interest-bearing debt, so bank debt, bonds payable, capital lease obligations. Those are what constitute, in most circumstances, debt, as opposed to, say, accounts payable and accrued liabilities. So if we subtract enterprise value, or subtract debt from enterprise value, we've got the net equity value. And we say net equity value, it's net of the company's cash, because $1 of cash is worth $1. So for example, when Facebook went public, at the IPO, the implied value of 100% of Facebook stock was $100 billion. However, post-IPO, Facebook had about $20 billion worth of cash, so the equity value on a gross basis was $100 billion. On a net basis, it was $100 billion net of the $20 billion in cash, or the business was worth $80 billion. So enterprise value, what's the business worth without regard to capital structure? If we subtract from enterprise value the debt, we've got net equity value. If I were to relate this to the real estate markets, let's say your home is worth $2 million. That home value might be likened to enterprise value, because that's the value to anybody, no matter how they finance it. But if you've got a $500,000 mortgage outstanding, your net equity value is going to be $1.5 million. So we've got several forms of capitalization multiples, both from the public equity markets as well as M&A transactions, that represent values that can be calculated from comparable transactions, comparable publicly traded companies, using their enterprise value capitalization multiples. Then there are certain hybrid valuation methods that combine two or more of the valuation approaches that I just described. Just to show examples of a few of these in place, say we're valuing a company based on comparable company capitalization multiples. First of all, there's judgment involved in deciding which, if any, are the comparable publicly traded companies. There are more than 16,000 publicly traded companies in the United States, and so a number of factors need to be considered to determine, can you find some that are appropriate to the privately held company that you're valuing, recognizing that you're never going to get a perfect fit, but what you're seeking to do, whether it's to value a privately held company or you're an underwriter trying to come up with a view with respect to value to take a private company public, you would need to use your judgment in deciding whether or not there are appropriate comparables to use. And there are several multiples that can be calculated. For example, here we've got price to earnings ratios, price to cash flow, price to book, and price to sales. With the comparable companies, they've got their various capitalization multiples. Judgment goes into deciding, do you use the average, do you use a median, do you apply your judgment to come up with the multiples? So based on the financial data of the company we're valuing and the capitalization multiples of the comparable companies, we arrive at a range of values. And in some cases, this range of value can be rather wide. Then from the range of values, we need to determine what is the relative importance of those indications of value. And in this particular case, I've applied some weights to come up with a single weighted value. And if we were doing this in connection with an acquisition of a company, recognize that those equity capitalization multiples from public companies are based on minority interests in those companies. And so if we're using this to determine the value of a controlling interest, we would look at other acquisitions that have taken place that have relevance to the company that we're analyzing and determine what is the premium that was paid in those acquisitions based on the acquisition price compared to the price that existed prior to the announcement of the acquisition. So for example, if a stock is trading at $20 a share and you want to take the company private, you're not going to be successful, most likely, if you launch a tender offer at $20 a share. You're going to have to most likely offer some sort of a premium. So for example, if the company was acquired for $26 a share, the $6 premium compared to the $20 price would be a 30% acquisition premium. So if we add the acquisition premium, we've got the value of the company on a control basis. If we're doing an analysis of comparable transactions, the capitalization multiples in those transactions already have an implicit premium that is built in, since they reflect the price that was paid for controlling interest. And again, if we have multiple capitalization multiples that we think are relevant to the company, we have to use those to come up with a single value based on some sort of a weighting system. And then finally, discounted cash flow analysis. We're valuing the company based on the present value of projected cash flows. So we've got to project the cash flows. But in this case, if they only go out 5 years, at the end of 5 years, the company still has value. So we've got to calculate what's known as the terminal value, the value of the company at the end of the 5-year period, and include that also as among the future values that need to be discounted to a present value to come up with a value for the company. And recognize these valuation approaches are not going to all produce the same values. Sometimes the range of values that is produced can be rather large. So both experience and judgment is needed when there are several indications of value to come up with a single comprehensive value. In getting experts to assist you in valuation, there's two general types of experts. And this is a gross generalization because there are many experts that have attributes of both types. But if I were to generalize, there are what are known as transactional experts, where their business is basically arranging transactions, and that's how they get the primary payment. For example, investment bankers, business brokers, in certain cases, industry experts. They may have a pretty good understanding as to what the value of a business is, although they're not necessarily proficient in being able to document that value in the context of a document that could withstand scrutiny in litigation or for other purposes. Then there are documentation experts, typically employed by valuation appraisal firms, accounting firms, consulting firms, and sometimes investment banking firms, where with the documentation experts, the good ones are proficient at being able to prepare documents using methodologies that can withstand scrutiny, although because many of them are not that actively involved in the transactional arena, there are times where their values may deviate from what would make sense. Valuations is an unlicensed business. Anybody could purport to be a valuation expert, and historically many have no particular licensing or training whatsoever. However, in recent years, as this become a more mature profession, there are some licenses that are more commonly held by some of the more experienced valuation experts. The oldest and the one that is generally regarded to be the most challenging to earn is Chartered Financial Analysts. That's been around since 1963. There are more than 100,000 chartered financial analysts in the world, although many of them are involved in doing valuation in connection with the public security markets or in working as portfolio managers. Then the next 4 designations are designations that are specific to people who are involved in the appraisal profession. For example, ABV is designation that is granted by the American Institute of Certified Public Accountants. And then finally, recognizing that in financial distress, bankruptcy, that is not a normal circumstance for applying business valuation methods. In a lot of cases, there are rather unique circumstances as well as legal issues that have to be understood. There's also a designation that's very specific to dealing with companies that are insolvent. And professional standards, here's another area where there are none, in a sense, in that there is not a single unified set of professional standards that all valuators adhere to, but rather there are a number of sources of standards that could potentially be relevant to the practice of business valuation. And there are many professional evaluators that don't necessarily make reference to any of them. So they do exist, but they're not necessarily standards that are universally adhered to. And so that is my equivalent of going to Europe and visiting 10 capitals in 8 days. We've had a chance to cover a lot of ground in the limited amount of time that we have allotted. I want to thank you for being with us and want to open up the floor to any questions. If you notice, there is a chat feature that you can use to ask questions. So I want to welcome you to ask questions either right now or in the follow-up. You can contact me either through the Expert Institute or on a direct basis. I'm easy to track down, and I'd be happy to address any questions that you have either now or in the future.
Okay, everyone, if you have any questions, now would be a great time to
enter them into the question window, and Ron can answer you verbally. If not, feel free to email your questions into webinars at the Expert Institute. Oh, here we go, Ron. I think we have one. Ron, are you seeing this question? Okay. I want to thank everyone for attending today. I will follow up by email with a copy of these slides and the video recording. Ron, thanks again for your time, and everybody have a nice day.